Welcome to the AOG conference in New York City. I'm Jane King, and with me is Aaron Rosen of AOG Institutional Fund. So explain what AOG does.
Yeah, absolutely. Thanks. So our fund is really trying to bridge the gap between institutional investment access and opportunity with non-institutional investors. We use an interval fund kind of structure, a wrapper, and then we broadly diversify across all the different potential alternative asset class arenas and sectors. So we have real estate, private equity and debt, hedge funds, venture capital. We do direct and co-investments as well as other funds. So we really try to kind of be this core alternative solution for investors or advisors with clientele who are trying to figure out a way to either create a more efficient solution for alternatives within a client portfolio or venture into it without having to make some of the more intensive work, diligence, access points, that sort of thing. So we try to add a lot of value in those ways and really simplify life, if you will, across the other things and let people do what they do best.
Now, who would you say these are particularly suited for?
Yeah, it's very much designed for an average investor. I mean, we have a $25K minimum to invest. It is accredited investor at this time. But really, it spans the gamut. It could be anyone from an individual investor that's kind of accredited / high net worth, all the way up to kind of a smaller family office or even endowment. We have a couple of decent sized family office and endowment clients as well. People use it in different ways based on where you are within that. Some people use it as the core solution and then create satellite approach from some of the things that we've invested in. They kind of piggyback off of our diligence or access. Others will pick other ways, something that is a tax efficient standpoint and try to target other goals with it. So it can really be used in a number of ways, but the most important thing is really to create kind of a simple, if not, elegant solution, right? That simplicity is really the most important part. So you don't have to worry about allocating, do I do this much in private credit versus real estate right now? Or how do I pick from that manager to this one? Or how do I get access to that fund? And I don't want to have to deal with K1s and capital calls and all of the, the rigmarole and pain points that always occur with a lot of that private investing.
How are you thinking about investments in terms of the election results?
Yeah. So this has come up quite a bit recently, before the election and after. I'll say this, one of the things that we try to do within our pipeline for prioritization is really prioritize investments that are uncorrelated or agnostic to either a certain economic environment or a certain political environment. So we try to insulate ourselves, the known unknowns versus the unknown unknowns. And to identify that, to find areas that will produce and perform with consistency regardless of what happens there. I always like to say, look, we don't want to make a bet on who's going to win an election or what interest rates are going to do, because interest rates are affected by a lot of different things, as is the Fed, and you're more likely to go broke than get rich betting off a politician to do what they say they're going to do. So instead, we got to remove some of that risk from things, right, and simplify the process to things that perform regardless, so that when I wake up in the morning, when we wake up and think about this, that's not the concern for us. The concern is about the idiosyncratic nature of things within the portfolio itself.
What are some things that perform well, no matter who's in?
Yeah. So one area is kind of government defense.
Okay.
So that's one area that we have a healthy part of the portfolio specifically allocated to mostly on the debt side, but both debt and equity. But if you actually look at kind of government service contracts, and how often they get paid, and they're generally done in 3-year contracts, especially with smaller companies. These companies then need to have access to additional capital to ramp up for them. The default rate in those areas is incredibly low. It's like 1% of 1% for those type of companies. It's incredible. It's almost agency-like in nature. It's really fascinating, but the yields that are generated from the debt are significant net double digits. Same on the equity side. The key is having people that are connected into those networks and understand what's going on, and they've identified those areas. So that's one place where we look at this perpetual kind of dollar funding, right? Whoever comes in, the entity is still getting funding, and then specifically within that, drone technology and AI tech specifically, where we have a particular thesis around that. The incremental dollars within that budgeting has been increasing every year for past 5+ years into that area. So it's only getting increasingly larger amounts of the overall funding. And so we look at that, we think, okay, if that's the paradigm there, and that's going to be generally agnostic to who's sitting in what seat, that becomes more attractive to us.
Very interesting. Aaron, thank you so much.
Absolutely.
Thanks.